And good evening, ladies and gentlemen. Let's talk about long-term funding and how can we build into our case study. So, on the lecture I was talking about the different theoretical aspects of long-term funding. Let's see that how can we price in the bond of the company which was issued. If the company was selecting the option to issue the bond, because if you remember, then we had the chance to collect or to renew our liabilities by issuing 3 million euros of worth of bond at 3 million initial market price and actually with Euribor interest rate. So how can we do it in Matlab? Actually, there are some definitions. So first of all, we have to say that, okay, what is the period of bond? This is the frequency of coupon payments. So if they are paying interest for us, it's annual. So if they can pay it only once, it will be annual. It can be 4, so they are paying quarterly in each year, or it can be a monthly payment. So let's say it will be annual. Then there is the basis value. Actually, it's much more practical, so they need it for day count conventions. Sometimes, for example, when you have to deal with February or longer months or shorter months and so on. But because Matlab can do it, so actual, it's no problem otherwise. And end of month rule, it will be 1 because we are paying always at the end of the month. So let's reset. And then we have to start to define the date. So we know that the bond will be issued on the first day of 2020. Then it has a 5-year long maturity. Also from our rule book we know that Libor is something like this. Okay, if you want to be precise, Libor Euro, right now it will be a negative number, I think. So, well, it's a negative number. Do we want to deal with this? Yeah, let's deal with it. Let's see that what is happening in this miserable situation. Okay, it's percentage, so we have to add some zeros. We have to define the spread. This is plus 2%. And period, basis, end of month rule. Oh, I got this 1. Also, we have to define the principal. Let's say it's 100. We don't want to overcomplicate things. And after that, we have to define the instrument. So we have to define the object. In this case, so it will be a floating bond, maturity spread. If it's fixed, then it will be coupon rate, the name for that. Reset period, basis 0. Actually, basis. We don't want to change this so often. Principal, date time, first coupon date for floating. Yeah. So we are defining this object, and then we are moving on to see that, okay, we need a rate curve object. It will be a 0 rate curve object, so it means that we have to collect 6 months and 1, 2, 3, 4, and so on, 30 years of yield or rates, but it will be bond yield. So let's go to our friendly German. Yeah, we can see that there are many things, but we are looking for the 0 here. Oh my god, how devastating is this? So disappointing. Can we copy it here? Let's remove the tabs. Actually, it doesn't matter, but still. Ah, it's terrible. It's terrible. Okay, and still we don't have to forget about this, that we have to divide it by 100. And also we have to transpose this. And now we can delete the original version and add 3 dots. Okay, let's see that is the calibration precise. Okay, we don't have 6 months. We have 1 month, 3 months, and for the years 1, 2, good, 3, 5, 4 is deleted, 3, 5, 7, 10, there is no 10, there is no 15, yeah. Okay, let's hope that rate curve has been loaded. So it's still an object. We can see that these functions are just collecting the data in some nice packages, so that's why it's called as an object. And then let's see that what is the price. So if you are purchasing this bond today, the price should be something like this. So we could purchase the bond at the issuance at a 110.26 price. And if you are thinking about the yield, actually also we have a yield function which is disappointing. Yep. Also, this script was prepared to deal with amortizing bonds. So when you are paying back some percentage of the principal, so we can say that, oh, we can turn this on. Let's make it uncommented. And also we have to turn this thing to 1. And then we can see that what is the difference. So let's remember that it was 110.26. So the price will be lower, because if you are paying back the principal, obviously you will pay less and less interest. So that's why your interest payments are declining, and that's why the present value of all these interest payments will be lower. So for the company, actually, an amortizing bond can be a much better solution from this point of view. On the other hand, it can be problems because if you are not amortizing your bond at all, then you can renew it easily because you are just issuing a new bond once it expires. So then you can collect the capital and then you can be really happy with that. Okay, so let's see another thing. So what is happening when we are changing the year? So okay, let's say it's plus I. So let's make a for cycle to see that what is happening when we are approaching the maturity of the bond. So what is happening with the price? Sorting? No, it can be 4, 5. Yeah, it will be good. Oh, we don't want this. Do we want to have the yields? No, it's not necessary. Good. Then let's see the lot price. So we can see that it's a completely linear function. As the bond gets older and older, then the price will be lower and lower because we are just the amount of future interests is declining. But you can ask the question that, okay, but it's a floating bond. So what is happening with the price when actually the LIBOR moves away from this miserable state? So let's see that. Okay, for a equal 1 to 10 plus j divided by 100, and in this case adding 1%, 2%. Yeah, it's reasonable to scale it this way, and at least we have other dimension. Yep. And now it's a surface because it has 2 dimensions. Now let's see this beauty. Okay, let's turn this around. So we can see that it's completely linear. So we can't find any nonlinear functions. So as time passes, it doesn't matter that actually what is the underlying LIBOR rate. They are completely independent from that. So it's price decreases. That's all. Also, yep. So if we are able to see that, okay, if the LIBOR rate would increase by 1%, actually it has not so many effects on the bond price. So LIBOR is just flowing through. this bond, and that's all. So yeah, that will be the second lesson here. And so this is from investment or investor point of view. What we can say. On the other hand, with respect of all this nice 4 cycles, so let's take this thing down and let's turn this back to 2020. Okay, Libor is back, fixed. Also, 4 cycle will get recommented. Yep. And no surface at all. So let's see that is this bond. Index position 1 is invalid. Yeah, sorry. Sorry. So, what we can say about this bond. So, can we sell a bond like this on the market? So, if you are looking on corporate bonds in Germany, so we can see that for 3-year bonds, actually the yield supposed to be 0.18. We are a bit far away from this level. So actually, so the company is supposed to have at least single A rating to have a realistic yield here. Otherwise, we should increase the spread. So what is happening if we are increasing the spread here? 0.4. It's still not enough. Okay, let's write a cycle for that because we don't want to spend so much time for this. So one, let's say we are increasing by 1% with each step. And okay, maybe yep. Okay, that was not the most efficient way, but whoa. Wow, surprise. Actually, it's highly impossible to step out from this negative level. Because of pricing. Okay. So just increasing the spread will not contribute if the price is similar. But what will happen with the price? So we have to run this thing again. Just now I will be wiser, but I will turn this thing on and put here this. Oh, this will be fast. Yep, it is. So again we had this curve here, but what happened with the price? Oh my, the price was increasing drastically. Okay, so the price was obviously affected by the spread, so it's not an artifactum that we were able to find. Coupon rate, settle date, maturity, period, wages, and months will settle. Why do we have here settle twice? Oh, ho, ho. Real wages. Let's do this thing again. Because maybe I was loading wrong inputs to this period. If it remains the same, then okay. Now it remains the same, so actually it's hard to say that. Basis, yeah. Okay, so we were able to see that what is happening from investor point of view. Just I'm turning things back to their original state. And they were nice. And now let's save this. So what is happening with the company? Because from investor point of view, it's always so nice that, okay, we have, or it's not nice, it's actually a problem is that we have this so highly negative interest rates and yields. But let's see what is happening when we have to change our interest. So somewhere here, yeah, we have the debt. Actually, what is the name of our debt? And yeah, so it was written here that We will abandon this later on, and no, we're not. But maybe today is the day. So for we never had triple R in the script, so until and also we have to introduce some measurements here. So first of all, we can copy this Libor spread structure. Okay. But now we should delete this thing because this is the setup from the case study. And Libor spread will be R depth. And then also we can turn this thing on and we can say that okay, and what is happening when Libor increases? In the highly unlikely situation then this terrible thing can happen. Okay, so we have to add some new dimensions to the data. Yeah, just we already have local and cat. Maybe we should turn off one of them. So let's say that right now we know what to do, which locomotive to prefer, so this pretext profit will go to sleep. But we are keeping the cat, because still we can compare the different hedge scenarios. Yep. Our variable names are becoming stranger and stranger. Okay, and let's stick loco in one state. Let's remove the for cycle completely from here, and let's say that we are using Siemens. That's all. Cat is cat. And we need another end to make this work. Oh, not because we removed the other for cycle, so we don't need another end. Let's see, is this working or not? First of all, I will make an alternative name for that. Let's save as loan. Actually, it's a bond, but doesn't matter. So Please don't freeze. A categories function of variable depth. What happened here? Maybe I accidentally deleted the depth. That's the reason why I did not want it to overwrite anything. Yeah, 41. What there is depth? It's strange because this should be able to be arranged because it's a simple for if else function. So let's check it. So deposit. Are you defined? Yes, it's defined. Good. Is depth defined? Oh, it cannot be defined. Wow. Okay, it's a so without the for cycle, you need such a description. Okay, now it's done. Yeah. Oh, it's so nice. I don't know what we can see here, but it's nice. So, having share values and increasing interest rates 1 by 1 and 1% here. Maybe it's too aggressive, but at least we can see that when it goes down to 0. So, and in which year? So these are the years. So this is today here. And this is also the current interest rate without modification. And we can see that if interest rates would suddenly increase as a shock for the company, then what would happen? Corporate value would go down to nearly, were we able to reach 0? No, we cannot. It's still yeah, just we can see the difference that, okay, what is happening when we are at the current interest rate environment, which is completely zero, and when we are at, okay, under complete terrifying shock. Okay, maybe we should make this more realistic because we are comparing the end of two disasters. So looking for the beginning of the fourth cycle. Yeah. So let's see that what would happen if we would increase the interest rate by 10%, not by 100%, because the result is less dramatic. Yeah, so this it's highly miserable that this is 11 years and this is a 10% interest rate change. So if we would increase the interest rate by 10%, it's perfect. Oh, it's so beautiful. So we can see that in the current state, without hedging, the price or share values would go down to 1,266 from the present higher value, which is something, which is 1,440. Neat. So let's see what is happening with the probability of default. And with the probability of default, whoa, yeah, because we don't have so much money. Yeah, it would also, yeah, in this case it would increase by 83 and yeah, by 2%. Okay. And what is happening with pre-tax profit? Okay, pre-tax profit would go down drastically. So we can say that it's decreasing to 47, 49. So yeah, it's actually it's not that drastic a change. So compared to the exchange rate movements, it's not that important. So if we are looking on this company, we can say that exchange rate movements has a way better importance for the company than interest rate changes. So they are still profitable, they are still worth something. Okay, it can have an impact, but not that. It's something like this. What we were able to see with the exchange rate. So that's for the nice conclusion for today. And next week we will start to deal with lease contracts. Hello.